Hi traders, welcome to this video. Today I'll be teaching you about market structure and how you can use it to determine market direction with precision. I'll share live examples to help you apply this knowledge right after watching. The market is always moving towards the next PD arrays, and it's our job as traders to figure out which one is being targeted next so we can capitalize on that move. That's why understanding market structure is crucial. It's one of the first things I analyze on higher timeframes to determine market direction before I drop down to lower timeframes to look for entries. Without further ado, let's get into it. Market structure is divided into two key concepts. 1. Intermediate term high and intermediate term low. 2. Short-term high and short-term low. In this video, we'll focus on intermediate term highs and intermediate term lows. In the next video, I'll dive into short-term highs and lows, which will be part of a video dedicated to order flow. So, what is an intermediate term high? It's a swing high with swing highs on either side of it. For example, right here, this is an intermediate term high because it has this swing high to the right and this swing high to the left. This is an intermediate term low because it has this swing low to the right and this swing low to the left. If you're unsure how to spot swing points, be sure to watch my previous video linked up here. But why is it important to identify intermediate term highs and lows? In a bullish market, intermediate term lows tend to be protected, meaning the price won't trade back into them. Conversely, in a bearish market, the intermediate term highs will be protected. So it's simple. Whenever you see the market respecting intermediate term lows by not trading into them and disrespecting intermediate term highs by breaking through them, you know you're in an uptrend and should be looking for higher prices. Here's how you can apply this to your charts. First, in the daily time frame, mark your swing points. Then, zoom into the 4-hour and 1-hour time frames to identify the intermediate term highs and intermediate term lows. If these highs and lows are clearly visible on the 4-hour time frame, there's no need to drop to the 1-hour. After marking them, observe which side the market is respecting. If it's respecting intermediate term highs and breaking intermediate term lows, the market is in a downtrend. Look for the next PD array, as it's highly probable that the market will target it. But that's not all. You'll need to drop into even lower time frames to look for entries, something I'll touch on in upcoming videos. Now let me show you an example of how I apply this on the charts. Here's the US dollar-Canadian dollar pair on the daily time frame. Let's mark all the swing points and fair value gaps. You can mark other PD arrays too, but let's keep it simple for now. Now let's focus on this part by zooming into the 4-hour time frame. In the 4-hour, let's mark all the intermediate term highs and intermediate term lows. Once they're all marked, you can see that the intermediate term highs are being respected, while the intermediate term lows are being traded through. This is a clear indication that the market is in a downtrend. So what's the next target here? It's clear. The next PD array, which in our example is this swing low. That wraps up our dive into market structure. If you haven't watched my previous video on PD arrays, I highly recommend checking it out. The link is in the description below, and it's essential for understanding the foundations we've built on today. If you're looking to go even deeper, I offer examples, quizzes, and additional learning materials in my free Telegram community. It's also a great place to ask questions and get direct answers from me. You can join the community using the link in the description. I'd love to see you in there.